Good morning, everybody, and welcome to the latest Urban Living webinar. Today, we are going to be looking at what's next for living sector investment. It's a pretty topical subject at the moment. There's been a lot going on in the last few weeks, and we've got a lot to talk about today. My name's George Sell. I'm editor of Urban Living News, and we are a B2B online platform for the living, flex workspace, and hospitality sectors. Today's webinar is going to last an hour. We're going to have around 45 minutes of Q&A with our panel. We'd like you guys to get involved as well, so we're going to have a poll coming up shortly, and we'd also like to hear your questions. So you can submit those using either the Q&A or the chat function in Zoom, and we'll either answer them there and then if it's on the topic we're discussing, or we'll save a bit of time at the end of the session. Everyone who's registered for the webinar will be emailed a link to a recording. And there's also a quick survey at the end, which would be grateful if you would take part in. Now, before we start the conversation, I just wanted to show a few context slides. The following are all stories that we've run recently on Urban Living News. There's been it's been a bumpy couple of weeks, let's put it that way, and the bigger picture is very mixed. So on this slide, we've got things like John Lewis leaving the build to rent sector, which has kind of sent a few shockwaves through the industry. We've had Amro repurposing an asset down in Croydon from build to rent as an apart hotel. We've had trade bodies calling on the government for targeted specific support for build to rent, and we've seen a drastic fall in new build to rent construction starts, 80% in London. Probably not quite so much in the rest of the country, but still down quite a bit. So that's the bad news. On our next slide, you can see that there is still plenty going on. There is new capital coming into the market, and we're seeing, I think, more institutional money coming in. The kind of capital that is patient enough to kind of go through the ups and downs and the cycles we're seeing at the moment. So there's the LNG story there, top left. That's a big new scheme that they've acquired last week. Bottom right, you're seeing local authority pension pool making a debut in the single family sector. So there is money coming in. UK PBSA investment was up by 10% last year. Gateway 2 approvals are finally getting towards the time scale that's intended. That's one of the issues that's made a lot of projects unviable. So there's progress there. And there are new projects breaking ground all the time, including one up in Glasgow. They're from Alumno, which we might hear about a bit more from David shortly. Now, if we go on to our next slide, I did a little LinkedIn poll yesterday, and I asked my contacts if I were to give them a theoretical 200 million quid, where would they invest it? And you can see the results there. Single family rentals was a comfortable winner, followed by co-living, with multifamily in third and PBSA in fourth. So that was my LinkedIn contacts, and as you can see on your screen, we're doing a poll of everybody who's live on the webinar now. So if you wouldn't mind filling that out, and we'll discuss the results of that towards the end of the session, and it'd be interesting to see how that compares with my LinkedIn poll from yesterday. Okay, I think that's enough for me from now. It's probably time to meet our panelists now because they know much more about this sort of thing than I do. So I'm going to ask the guys to introduce themselves and we'll do it as we see them on the screen from left to right. So first of all, David, good morning to you. Could you give us a quick introduction, please?
Yeah, good morning, George. Good morning, everyone. My name is David Campbell. I'm the founder and managing director of Alumno. We've been in existence for about 15 years plus now. We are predominantly a PBSA developer. I think, over the years done about 10,000 beds now. A lot of it mixed use, admittedly. And we've worked from Aberdeen down to the south coast. A few years ago, we even ventured into a few projects overseas. Yeah, I guess the last, as a kind of quick preamble, I guess last 18 months or so have been probably the most challenging that I can remember in my time doing this. So look forward to discussing some of the themes in a bit more detail.
Yeah, excellent. Thanks, David. Kelly, welcome to you.
Good morning, everyone. Kelly Bream. I'm a strategic real estate advisor, and predominantly my background is in sort of operations, so a lot of experience in operating platforms.
Short and sweet. Thank you, Kelly. Richard, good morning to you.
Morning. Yeah, Richard Stonehouse. I run a business called Victus Real Estate. I've spent the last, all my career in the agency world, and latterly in the residential world over the last 15 years. And Victus works across the living sectors, multifamily, single family, co-living and affordable housing principally. And we work with developers and investors bringing capital into the sector, either in developments or income producing assets. And we get involved all the way through the life cycle, from pre-planning all the way through to business plans and asset strategies for assets and portfolios.
Thank you, Richard. And last but not least, Will, good morning to you.
Morning, everyone. Hi. So I'm Will Skuse. I work at a company called Package Living. For those of you who don't know us, Package Living is a sort of living specialist investor, developer, and operator, so sort of integrated party there. And we have live strategies across single family, multifamily, co-living, and recently we've expanded. That's all in the UK. Recently expanded onto the continent. So we have a kind of business out in Spain, which is investing in flex living, which for all intents and purposes is co-living. It's a sort of slightly different take on it over there. But we've been live as a business for 8-9 years now. Portfolio across the kind of asset class I mentioned is sort of 4,500 units, and that's in either stages of land that's going through planning, procurement, delivery operations, so kind of across the whole life cycle.
Excellent. Thank you, Will. Okay, let's start by running through the asset classes and kind of establishing where we think investor sentiment is currently towards them and how we think that might evolve over the next year or two. We'll start with multifamily, and Kelly, maybe I can kick off with you on that one. How would you assess the situation at the moment? It's certainly been an interesting few weeks, and how do you think it's going to, be over the next year or so?
Yeah, I mean, I guess if you look across all of the sectors, I still think that sentiment remains broadly positive. It's certainly become more disciplined, and yes, we sort of continue to have some of these hurdles. But I think if you look at the multifamily build to rent, institutional capital, I think still views it as a core plus allocation. The fundamental demand story is very strong. There is a structural undersupply of high quality rental housing, and home ownership is still increasingly becoming out of reach for a large cohort of people. That said, the sector is still navigating some real short-term pressures. Construction costs remain elevated, debt requirements, are rising. You've got planning viability, negotiations that are protracted. And I think particularly when you then start to factor in affordable housing requirements and legacy land values, there are still some challenges. I think operational complexity is probably also underestimated by some of the newer entrants. But for investors and operators who can deliver a differentiated product and a strong resident experience, I think the long-term capital appetite will remain strong.
Yeah, thank you, Kelly. Will, you're in an interesting situation because you've got single family, multifamily, and co-living in your portfolio. How would you assess the kind of sentiment and of your investors to the various asset classes? Which ones are you seeing most interest in at the moment?
Yeah, no, thanks. So I think just to sort of, I guess, add on to the multi-family thing. So I think Kelly's absolutely right. I think in terms of the story around occupational demand, in terms of the sort of sentiment from investors to access those income streams, is very strong. One of the big difficulties in that sector is just viability of development. And that is related to the cost of the stack, so the whole capital stack, investment value is coming down as the yields are pushed out, build costs coming up in recent years, as we've sort of seen quite a lot of inflation in that space, debt costs increasing, and then that kind of coupled with the cost of capital for core and core plus money kind of shifting out a bit alongside kind of yields pushing out, and just that availability of that type of money. So kind of core plus money is not really there. So the returns, or it's more limited in this current market. So in terms of the ability to actually go through the traditional routes of development, it's really challenging there. And that, I think, is one of the reasons why you're seeing a lot of the statistics around completions are up, but starts are down. I think that's just a note on that, is I think that's particularly acute in the regional markets at the moment. Whereas a few years ago, we had a bit of a shift where London was very expensive, land was expensive, build costs were expensive, even though that had been the kind of the core market. There's a big shift out to the regions in terms of where stock was coming through. Whereas more recently, I think it's almost gone the other way. So because of that contraction of the market I was talking about in terms of the capital, that core plus money that is around, they want to be in London, Manchester, Birmingham, Leeds, Bristol, kind of Glasgow, Edinburgh, those kind of core cities. So actually those kind of more kind of secondary regional cities, even if the development kind of stacks up in terms of the appraisal, the demand actually is relatively limited from the potential investors for that. So that's been a big challenge. I think that market is one of the toughest at the moment, multifamily, at least kind of what we're seeing. We'll get onto it later in terms of how deals are being structured in that space, but that's kind of one where a lot of thought has to go into the actual complexity of it. Single family, on the other hand, is one that remains strong at the moment. So similarly, strong fundamentals around supply-demand dynamics in the country. But the big difference, well, the two big differences, I suppose, is one is just there's more fat in the stack. So in single family, obviously, you're building, houses in fields. There's not as much complexity about building towers. So the build cost is a much smaller part of the whole stack. So therefore, inflation in that space is less of an impact. The second part of that is the main route to market is through partnering with house builders. And these house builders, these guys have, access to tons of land. They've the ability to deliver, their standard house types, their standard kit in a very cost-efficient manner. So working with these kind of partners, you can actually make, you can make the stack. It works. There's enough in there that it's profitable for them to do. It works from the investor's perspective. And yeah, generally speaking, that's why we've seen a massive shift in that market. There's been institutional demand and capital going into that market. And interestingly, a lot of kind of core plus money, not necessarily massively broad in terms of the market. There's actually, it's probably dominated by a small handful of very acquisitive parties in terms of the single family space and what we've seen. But even with that, you've seen the shift where single family, I think last year was the first time as over half of the investment into the kind of wider build to rent market was accounted for by single family. And that's two things. It's obviously kind of, it's the investor sentiment coming from those particular parties or the kind of single family market, but it's just that viability point as well. And, I think that viability point is absolutely key because, the multifamily world, there's no demand, there's no question for people to do it, but it's just very hard to make a stack. Whereas single family, it all just stacks up a bit neater through the points I've kind of run through.
Yeah, thank you, Will.
No problem.
Richard, on our live poll, co-living is comfortably in the lead. Do you want to give us a little snapshot of investor sentiment to co-living and why investors are attracted to it at the moment?
Well, I think it speaks to a number of things. It speaks to viability from a developer's perspective, as Will has already articulated. The viability challenges around multifamily have made it very difficult as an entry point into the sector. So a lot of developers are starting to look at it. Equally, PBSA has its own challenges at the moment, both in the domestic market and the non-domestic market. So a lot of developers have been looking at the co-living sector as being a viable alternative to what they might have originally anticipated on their land holdings. So from a developer's perspective, seemingly it is deemed to be more viable. From a investor's perspective, I think there's going to be a lot of occupational demand for it because it speaks to the affordability challenges in lots of different markets. It also speaks to the changing demographics and people wanting that sort of flexibility. And so I do think there is likely to be a very big take up of co-living. But the co-living market does have its challenges, because whilst optically, I mean, on the poll, it talks about the demand being there, it is much more challenging from a funding perspective. We are still not yet seeing a huge amount of core capital that's particularly interested in the co-living space. And I think that will happen. It will change, it will evolve, but quite probably it will evolve when you've got an income producing asset class and you have a level of maturity to that sector, which we haven't quite seen yet. So where we're involved in co-living, it is by and large a higher cost of capital that's interested in doing that. And that's not necessarily a problem. I think the numbers do still stack up from that perspective. But at the moment, we have a slight divergence, because there have been a huge amount of applications in, say, if you take London, there's been a huge amount of applications for co-living, but that hasn't necessarily translated into a huge amount of development coming forward off the back of it, because the vast majority of that needs to be kind of vertically integrated, because, as I say, there isn't the institutional capital that's there to purely forward fund it in the way that we had with the evolution of the PBSA and multifamily market. It is coming, but it requires that alignment, and it requires the operational expertise to be leading it. And that's one of the pieces that we get back a lot from investors, is that they have a level of nervousness unless they've got that operational expertise behind it that says this is how it's going to operate, and how it's going to operate differently to multifamily, to PBSA, and so on. So I do think there's a huge amount of opportunity in that space, but I also think it is probably a market that only works in specific locations. I don't think it necessarily will garner the same interest from an investment perspective in lots of different locations. I do actually think, by the way, I think occupationally there will be demand in a whole variety of locations, but from an investor's perspective, I can't see it deviating away from both London and probably key very urban locations, very highly aspirational locations in major cities, and possibly commuter hubs too.
Richard, do you think the fact that there's still quite a lot of inconsistency around planning policies for co-living, is that also making investors nervous?
Yeah, I think so. I mean, it's a debate that is constantly being had, C1 versus sui generis. If you want the flexibility of being able to provide people with that kind of shorter stay options, then you go down the C1 route. But there is nervousness from investors. That's undeniable, about what that looks like from their exit. And every investor will start from the point of, how do I exit this in however many years' time that I want to get out? And there is a nervousness about first of all, what is the demand for a C1 a planning use class when I exit, and does that come at a higher yield than the sui generis use? So I think that is it's still a live debate. For what it's worth, my personal view is I think there's absolutely a market for both, and I think they will converge in many ways over the next few years.
Yeah, thank you, Richard. David, let's move on to PBSA. You mentioned it's been a challenging couple of years. How are you seeing your investor base seeing the sector, and what kind of activity do you expect to see over the next year or so?
Yeah, I mean, I think there's still appetite. There's definitely quite a deep pool of capital that I think wants to continue to invest in PBSA, but it's been much more, I think it's much more selective now and much more nuanced. And to be honest with you, I don't think that's very different from my experiences previously in other cycles. There's locations that are doing particularly well, and there's others that are not, and it's often to do with the recycling of the properties and the generational stock, and then obviously it's very susceptible to international intake, student numbers generally, etc. So I do think that the capital is there. There is a willingness to look at good opportunities, but as I say, it's a much more patient approach to this now, and a much more detailed and focused approach to it. I mean, it was interesting actually in your poll to see sentiment has dropped to 11%. I mean, I thought it would have dropped, but maybe not to that extent. But I think that's probably a reflection of occupancy was challenging across the board last year. And I think that's fed through in a number of levels, particularly to people's strategies going forward. And then obviously there's a few big headlines and in some ways from Unite, etc., the turn of the year, which, to be honest with you, I wasn't overly surprised about. But it's maybe giving people some food for thought and maybe thinking more about, right, if we are going to deploy capital into PBSA, how do we do it? Where do we do it? Can we play a longer term game? I think the key issue for me, I mean, I'm one part of the cycle, so obviously I'm at the kind of origination of opportunities stage and the development side of it, and that's not without its challenges clearly, but the whole issue around affordability, I think, is the biggest challenge, I think, that needs to be met head on, and how do you actually truly make projects deliver on that, and it's becoming increasingly difficult, and obviously the funders are looking at that in terms of ensuring that you're starting from the correct income base and that the schemes have got a better than good chance of achieving the occupancy levels that they need to achieve in order to stabilise the asset longer term. So I definitely think it's a resilient sector. It's proven that over the years. I think it will continue to be resilient. But I think, you know, having a track record, having an ability to kind of go the whole yards with schemes is becoming increasingly important from the side of an investor looking in and wanting to deploy capital. But as I said, I don't think it's going to fall off a cliff at all. I think it's just going to be more specialised, and there'll be a divergence in terms of where the capital wants to go. Certainly from our point of view, I was interested to hear Richard's comments on co-living. I mean, that's something that we have been looking at for quite some time, just because it felt like a natural progression for us. I think on the back of, certainly in London, occupancy challenges last year and so on, we've started to reappraise certain opportunities that we were considering for PBSA, looking at that as would it work for co-living, but I do agree with Richard that I think it's very much in its infancy still at the moment. There's clearly not a lot of transactional evidence, and I'm not overly convinced that it works across the country. I think central London, absolutely no doubt. And then I would agree very more sort of urban, centralised, exceptional locations in sort of your Brightons, Bristol, Manchester, those sort of cities. But certainly from my point of view, it's something that I think it's got legs, but it's probably a longer term thing.
Yeah, thanks, David. Richard, did you want to come in on the PBSA piece?
No, I was going to just pick something up. It just occurs to me on the basis of the poll that was done. It's quite interesting on the multifamily piece, because I think you could possibly have disaggregated the income producing story from development, and I think you might get a slightly different response, because I think conversely you've got a situation where the viability of delivering multifamily is extremely challenged, to the extent that I don't think I've seen many schemes outside of London where there hasn't been some level of grant funding requirement in order to enable it. But I actually think conversely that actually supports a really strong narrative on investment into kind of first generation multifamily, because inevitably, because of the cost of delivery at the moment in the multifamily space, almost anything that you're buying on the multifamily side that's income producing is close to or below replacement cost. Now, that's got to be a really, really attractive part of any investment proposition if you're able to say, well, it's nigh on impossible for someone else to deliver something that at the same economic level without being significantly higher in terms of rents in that local area. And I think there's a huge amount of opportunity on that kind of first generation multifamily side. And we're frankly seeing much more work on that side than we have done at any point since we launched the business. So I think that's quite an interesting area. And I think if participants in the poll had kind of looked at it in that way, they might have seen actually that's an area that's really interesting at the moment, particularly given that most investors generally don't really want to take development risk unless they can help it. But that has been historically the only way of accessing the living markets largely is that you've got to get into the development cycle, because we are, as a rule, generally across the living sectors, still relatively nascent in terms of the UK market.
Yeah, thanks, Richard. I just want to stay with you before we move on and ask you to touch very briefly on later living, specifically rented later living supply. That's bottom of the poll at the moment. Potentially in terms of demographics, it's the most undersupplied of these asset classes. Why do you think it's been so slow to take off?
Yeah, it's not because of the demographics that it's not gaining the interest, because the demographics are pretty clear. We've got an aging population, we've got a housing crisis. It is all of the kind of macro measures sort of align to investment into that sector. I think it's more of a cultural one at the moment, because we don't culturally, and I'm not going to be forgiven for this, but I seem to use my mother as the example in every time I talk about later living, which she'd be absolutely mortified to hear. But yeah, if I take her and her generation, and I talk to them about it, that the whole notion of moving to a later living scheme, they see it as a kind of knocking on death's door, which it doesn't necessarily need to be, but it's that perception point that I think a few things need to happen. I think culturally, we need to adapt over a period of time. The next generation will come through. As that next generation comes through, I suspect that they'll be more interested in that sort of in living in that sector. That's the first thing. But secondly, I think the sector as a whole needs to do, in order to enable that, needs to do a lot of work around changing that perception, which I don't think is being done in a particularly constructive way at the moment, to change that narrative at a political level, so that it then filters through the system. But no, we're not seeing an awful lot of it. I mean, it's a fairly nuanced part of the market at the moment. I also think the other thing is that in that space is, if you speak to anyone of that sort of vintage, they generally have become very ensconced into their local communities. So if you want to tap into that demand, it has to be driven very much by local demand. Your demographic has to be an existing demographic, because I don't think you get to a certain age where you think, well, actually, I'm going to move somewhere completely different, and I'm going to walk away from the community that I'm totally bought into. Using my mother, I mean, the notion that she would want to move different hairdresser or postman or all of these things that are part of her life, she won't want to leave that. So I think if it is going to be done in a progressive way, it has to be done with a lot of thought about how do you entice that local demographic into a scheme, and that's how I think it will work. That alongside a broader change of rhetoric at a higher level.
Yeah, thanks, Richard. Kelly, did you want to come in on that point?
Yeah, just a very quick point to add. I agree with what Richard said there. I think the other thing is later living is operationally really complex. It sits at the intersection of real estate, hospitality, healthcare, and that requires genuine specialist expertise. And I just don't think there is that in the market, which is probably another barrier for people entering.
Yeah, good point. Thanks, Kelly. Let's talk about the type of capital that's coming into the living sector. We saw on the context slides earlier there that while perhaps the private equity is more reticent than it has been. The very long-term patient institutional capital is prepared to ride out the storm. David, is that reflected in the kind of investor interest you're seeing in PBSA as well?
Sorry, George, probably unmuting you. Yeah, I think so. I mean, the capital that we've traditionally worked with. I mean, we have over the years done a lot of forward funding deals, which I'm sure we'll touch on, and that in a way sort of a reflection of the sorts of capital institutional backed investment outfits that we've worked with. I think there's still going to be an element of that involved in sort of PBSA projects. The structuring of it, those, is obviously open to a wider debate. There's obviously quite a lot of shift towards more joint venture type structures and participation in the project's success, if you like, at the end of the development process. But certainly from my point of view, that avenue still seems to be there. It's just obviously taken longer. And there's a lot more deliberation and a lot more debate around the dynamics of a project than certainly I can recall. Now, I don't know whether that's just a reflection of we're in a world where the data is much better, and a lot of these investors that are in certainly PBSA have done a lot of deals and have actually been through a few cycles, so actually know what performs well and where and what you need to instill in a project to make it a success. But certainly the whole process around concluding a project is certainly taking a lot longer. And there's another issue there as well in terms of the cycle of a project, from when you actually identify it, get it through planning, then deal with the gateway, then build it. I think we were in a world typically where a project would take, say, 21, 22 months typically to deliver. We're now in a world where it's taken sort of over 30 months plus. And that in itself is making a lot of these projects quite difficult to maintain their viability. But certainly having investors that have done the whole yards and have got the kind of systems in place to kind of to absorb these challenges obviously helps. And I think that in part sort of identifies who the more likely sources of investment going forward are going to come from. But certainly from my point of view, that's still very much a kind of live marketplace in terms of the capital that's looking to come in.
David, are you seeing any improvement in the Gateway 2 timescales? Is that?
I thought you'd ask me. I mean, so hands up, we've only done one, but that was more than enough. And that took, so let me get this right, that took 42, let's say 42 weeks. So for those that might not know, that the target is 13 weeks. So therein lies the problem. I believe that there has been an improvement, but I'm hearing this through sort of our colleagues and contacts elsewhere. I think going forward, we are modelling 25 to 26 weeks. Typically, we're assuming that sort of timeline should be sufficient, but it's still more than the 13 weeks, so it's still a bit of a challenge. But I really hope it is improving. George, like you, I'm reading the headlines and there does seem to be positivity around it, but I think only time will tell. We've obviously now got, I think later this year, we're going to see some of the first Gateway 3 processes coming through our approvals, hopefully. Now, hopefully that will be smooth, but there's a train of thought that suggests that once the Gateway 3 stuff starts to sort of come through, it might then cause a wee bit of a backlog with Gateway 2. So, look, who knows? It's just another layer of complexity that we've all got to deal with. And we're trying to get through it as best we can. You'd like to think that the more it becomes the norm, then yes, of course, it's going to speed things up. But it has caused a big problem. Let's not be about the bush. I think the other thing from my point of view is when we're looking at new projects, how can I phrase this? Maybe some of them lack the ambition that we might have put forward on a project before. And what I mean by that is we're maybe thinking, well, maybe we need to sort of design it and progress the project in a way that it might not need to go through the gateway to process. So that is not a great thing, I think, ultimately, but it's obviously something you can't ignore and you've got to consider. And when you're looking at processes or projects, I should say, in the whole. So, but look, fingers crossed that is improving, George. I think it would definitely be a massive shot in the arm for the whole development process as a whole, and subsequently investment.
Yeah. Thanks, David. Will, did you want to come in on the investor profile piece there?
Yeah, thanks, George. Sorry, I appreciate we've slightly moved on to Gateway, which is another topic entirely. But yeah, I mean, kind of just throwing my 2 cents in around kind of the investor profile and what that's currently looking like. I think one of the interesting things that we have seen a lot of, and it's, you know, everyone sort of will have seen the headlines around it, is some of that kind of local government pension scheme money coming into the sector, and particularly prevalent in the single family housing world. So, you know, we have seen, obviously there's been, you know, globally there's a decrease in allocations into real estate, which had a knock-on effect in terms of availability of capital, the bits we've sort of, you know, been through and rehearsed. But one of the interesting elements there is obviously there's a huge, relatively untapped sort of pool of capital there in terms of the LGPS money, which is exactly that. It's that patient money. It's looking there to, you know, to deliver housing, which is deemed as, you know, from a social perspective, a very good thing to be doing in a market where we definitely need it. And, you know, a cost of capital, which makes deals sort of work. So seeing Border to Coast come in on the acquisition with sort of Aberdeen, and then seeing kind of the PRS REIT transaction, sort of 2 pretty significant statements of intent from the LGPS world, I think is really interesting. And the conversation we've been having as well is, you know, a lot of these types of parties are involved. So that one, I think, particularly, it seems to be particularly at the moment in the single family world, but that is a, you know, potentially a sort of a real growth area in terms of capital coming into the market.
Yeah. Sticking with you, Will, for a minute, and going back to the Gateway thing, you guys have done a couple of these sort of low-rise multifamily or garden style or whatever you want to call them. Is that something that you think will become more prevalent? It's a talking point at the moment.
Yeah, definitely. So one of the bits, which is a strategy which we've sort of been working on, sort of, it's similar to a single family type product, but it's what we deem to be calling garden style, which is essentially kind of it there, you know, probably brownfield, edge of city centre sites, which once upon a time would have been, you know, multifamily sites. There would have been schemes where you go and stick, you know, 300-400 units of multifamily on. However, given the viability gap there and issues surrounding, you know, Gateway and things like that, one of the, you know, products that we think is emerging there is a kind of a garden style product, which sits somewhere in between build to rent multifamily and single family housing, where you're going for terraced housing, so sort of relatively high density housing, and then sort of low rise apartments and keeping it below the Gateway. Benefits being that you obviously manage build costs because you don't go above kind of, you know, 4 or 5 stories, and you know, that means the build cost is just inherently cheaper. But also your programs can be a lot quicker because you're delivering them in phases, like we have a single family, so you get to the income a bit quicker. And you don't have these long builds with sort of gateway processes built in. So that's definitely something which we think is an opportunity, and something we've been working on. And then coupled with that, actually on our co-living strategy, so we've got a London co-living strategy on some of the projects we're working on. We intentionally are doing that. We're intentionally going for, I think as David put, less ambitious with what we're trying to achieve, but on the basis that you've got a site where you can deliver, rather than 300 units, you're delivering 150 to 200 units maybe, keeping it below Gateway, and your build cost, your build program is coming in significantly, and your risk around Gateway is coming in significantly, which just means the whole appraisal works better. Because, you know, if we're thinking about debt on these things, you bring a debt day one, pretty expensive, rolling that interest for the whole project life. So you can shorten that life cycle, get to the income quicker, get to the stabilized position quicker. It has a massively beneficial effect on the appraisal. So yeah, 100%. I think Gateway, it sounds like it's definitely improving. We're in a couple of Gateway processes at the moment on some of our multifamily projects. Seems to be okay at the moment, but obviously not through them yet. And definitely sounds like getting better. But yeah, there's definitely, I think, been those like us who have had strategies around actually avoiding going through the Gateway process by things like garden style, by things like sort of slightly lower rise co-living.
Yeah, Thanks, Will. Sticking with you, Will, the single family sector is obviously fueled mainly by investors buying chunks of discounted inventory from house builders, usually standard house types. If, for example, the government introduces a new version of Help to Buy or something, and we see a series of base rate cuts and mortgage affordability improves, do you think the house builders will be as keen as they are now to continue supplying all that inventory, or will companies like you guys perhaps go into take on more development risk yourselves?
Yeah, no, it's yeah, it's a really good question. It's one of those, kind of future gazing slightly with it. So we have obviously considered this quite a lot when talking about our strategy and going forwards. I think undoubtedly at the moment, house builders, the for sale market is not going as well as everyone would like. And as a result, they're much more willing to deal in terms of bulk deals, selling at discount to the likes of us in terms of funding transactions, forward commit transactions, et cetera, et cetera. So the dynamic from a buyer's perspective is reasonable at the moment. Obviously, there's a limit to how much discount they will accept and won't accept, which always comes into it. So, for a certain amount of discount, they just won't do it. There is an alternate route for them there. But yeah, 100% is definitely at the moment, with the sales market being where it is, there's definitely more opportunity to buy. I think as that market, and you see that with some house builders are doing it as a strategy. They're building a team around doing single family housing as not just we're starting to sell, so we're going to kind of flog some of our kit, but actually as a part of their design. So within a scheme, there will be, house types, portions of it designed for single family housing, which are slightly different unit types. And the view being that it accelerates the delivery. It means they can deliver for sale alongside their rental product, which obviously gets them off site quicker. So all the kind of the managing costs, the prelims they have from running a site are significantly reduced. It's not purely a discount play. And there are others you see in the market who are probably selling the odd site here or there because it's opportunistic to do so. And I think you'll see a shift. I think you'll see those who have built teams around it, who have it as a core part of their strategy, who will continue to do it to some extent. It might not be as much as current. And you'll see those who are doing it sort of, as an incidental position at the moment, who will just shift back to the sales model. I think that kind of probably covers the larger parties. In terms of the smaller parties, a lot of the reasons why single family might work for some of the SME developers and house builders is because they are relatively capital constrained. So having someone be able to come in, buy the land off them day one, fund the delivery, and actually, allow them to make a reduced margin. But in terms of the ROCE, which is a big driver for some of these parties as a metric, it massively improves them in that sense. So I do think you'll still see some of the sort of SME house builder developers who are adopting single family, still progressing that, even if the sales market is stronger, just because it's another route to deliver more houses than they would otherwise do. So I think from our perspective, we don't see the market going anywhere. There will be shifts along the way. It's about having good relationships with the right parties that you hope to be able to do repeat business with, which we are, obviously kind of, focused on our side.
Yeah, thanks, Will. Kelly, we've seen quite a few investors and building owners launch their own operational platforms recently. Is that something you expect to see continue, that people kind of looking to find these synergies between having the operational platform and the real estate under the same sort of ownership structure?
Yeah, I mean, I think it's probably one of the biggest shifts that we're starting to see. And I think, investors want that OpCo control, or at the very least, meaningful influence over those platforms. And much of that has come down to experience. Historically, many investors that took a purely passive PropCo possession, relied entirely on third-party operators, and the outcomes have been mixed. So where the operators underperform, investors, often have very, they've come across a number of issues. They've had limited levers to intervene. And in some of those cases, that has created some reputational risk. So the key lesson has been that, the asset and the operation are fundamentally inseparable, and in a way that isn't true in more traditional sectors, like logistics or offices. So yes, as a result, I think we're seeing capital is increasingly structuring transactions to retain greater operational influence, whether that's through equity participation in the opcos, co-investment with the operator, board representation, or stronger governance and step-in rights. There's also a data element here. So, investors that have that visibility into the opco, they gain better access, more granular access into the operational that operational data, and that's really valuable for an asset manager, but also for the underwriting. That said, not every investor wants or should want, in actual fact, to run an operating business. These platforms are people and system intensive. Margins are tight without scale. They require expertise across marketing, customer experience, facilities management, technology. They're tricky. So I think the most successful models tend to be either you've got a fully integrated investor operator, or you've got a well-structured partnership where the investor has strong governance and alignment without necessarily running the opco. And I think, the key for me is ensuring that the investor and the operator speak a shared language and that there is genuine parity, because I think what we're seeing is the squeezing of operators' margins too far, that actually that's going to undermine the quality of the platform, the people that they can build in, what they can actually offer their clients, and ultimately that impacts the asset itself. So I think there's a number of things at play that need to be considered.
Yeah, thank you, Kelly. Richard, let's talk a bit about legislation. Are you seeing investment strategies influenced by legislation? I'm thinking particularly of the Renters' Rights Act, but other things going on as well.
Yeah, I mean, look, as an agent, George, I try not to talk about the threats to the sector like the legislation, but look, yes, we are. Look, you've already talked about the Building Safety Act and some of the impacts that we're seeing, and a lot of that is not necessarily particularly positive. Urban environments now that should realistically have much higher density schemes are getting lower density schemes as a result of investor and developer interest moving away from a highly protracted process, even if it is getting better at the moment. There are also clearly concerns about what the longer term impact of the Renters' Rights Act is going to be. And look, I think business plans are being adjusted to it, but I think it is still very much early days in terms of the Renters' Rights Act and how that's going to play through. Does it affect long-term institutional capital interest in the sector? No, but what it does do is it does make people think about adjusting how that business plan works, certainly in the short term. And it's possibly a little bit more of a threat if you've got a higher cost of capital and you are only holding for a relatively short period of time, where the greatest impact is going to be. But my sense, to be honest, on the Renters' Rights Act is that there's going to have to be some sort of adaptation of where we are at the moment, because I could see a situation where it becomes unhelpful for further investment into the sector.
Interesting. Thanks, Richard. Well, as an operator, as well as an investor and a developer, what's your take on the Renters' Rights Act? How do you think it's going to affect your business?
Yeah, so I think from our perspective, obviously, it's something we've been tracking quite closely, and have had concerns about how it's coming in. I think, generally speaking, a lot of the stuff that's in there is kind of best practice as a landlord, which you would be looking to do anyway as an institutional operator of these kind of assets. So the vast majority of the stuff in there is stuff that we would be looking to do, and just bringing the whole standard up to a level which you expect it to be. So generally viewed as a kind of positive on that sense. The bit where it's tricky is how you manage some of the potential unintended consequences. So how the arbitration process works specifically. So when you have challenges to rent rises, be they fair or not, is how quickly that can get processed, because that's something which, from an operator's perspective, is where you're probably most concerned around it. Is that you want to be driving very high standards generally, but when you're having residents challenging rent rises, which you deem to be fair, and part of the kind of business plan in terms of driving the asset on, and then you have to go through a process every time, it gets incredibly administrative, and sort of, quite high sort of just like operation intensive for the operator to do that. So that, and if that then takes months and weeks to go through, that's where it's really going to become a big issue. So I think in terms of how, and I think we have been through a couple of these already. So we've had a couple of these, not rents right, but sort of challenges to rent that have gone through a process and deemed to a sort of determination. And it seems to be working okay. But it's just in terms from our side, we need to make sure we are nailed on in terms of how it works, running the process and being as efficient as possible, because what you don't want to be in a situation is where that's dragging on and on and on. And then because the rents don't go up until such a challenge has gone through and it's been approved either way. So yeah, it's a case of sort of streamlining that process as much as possible, which will be as much on the operators themselves in terms of managing that as it will be on terms of the actual, I guess, the government institutions sort of in the background who are processing it all.
Yeah, thank you, Will. Let's talk a bit about lending. Obviously, the cost of development is high at the moment. Contractors are having a tough time. Their margins are low. We've seen some go under. So how's the lending landscape reflecting the situation at the moment? What's the lending appetite for the living sector? David, would you like to pick up on that one?
I mean, in terms of senior debt lending and traditional forms of lending, George, I can't remember a time, if I'm honest, when there's been so much around. So from a standpoint of the attitude towards it, it seems pretty positive, certainly for PBSA and also from what I can see for co-living as well. Again, very much driven by research and data and so on and so forth. So the right product in the right locations. But I think the sentiment's positive. I think the point that you made or touched on about contractors, I think obviously, there is a recognition that appraisals and models need to incorporate a higher level of contingency than they probably did previously. There's also a bit more around the terms and conditions around the surety of the contractor and payment terms and so on and so forth. But I think from my point of view, from what I can see, the traditional lending market is still there. It's still strong. And I don't see that tailing off any time soon, but it might be, as we touched on earlier, it's just more selective about what it backs, and possibly a bit more location sensitive. You're right about the contracting pool. It has got smaller, there's no doubt about it, but there's still good contractors out there. I guess it's more about when you're appraising an opportunity or looking at an opportunity. Certainly from my point of view, you want to make sure that you've got a good contracting partner alongside you and there's someone there that you can deliver it with. So as long as you're sort of going into it with your eyes open and you've got those relationships embedded, then there's still an ability to take forward good projects. I guess it's just the margins are tighter now and the risks are a bit greater, but has it ever been any different really from that? I guess it's just there's more of them, than there ever has been. But again, I think, from a lender's perspective, from what I can see, it's very much about backing up a party that have got a proven track record and can deliver. I think that's becoming quite a critical part of the assessment now as well. They're looking more at backing the people and the demonstrable ability to work through problems.
Yeah. Thanks, David. Will, you mentioned in an earlier discussion that you've been talking to a lot of lenders recently. Did you want to come in on that point?
Yeah, thanks, George. Yeah, so we've been through a couple of debt process recently, and I think exactly right, David's saying. So it's the lending market is really competitive at the moment, and that's primarily because you can get close to sort of equity type returns for debt type risk, which is obviously an attractive proposition. So there's not just the kind of standard banks. There's tons of sort of products available in that market and lots of alternative lenders getting into it. the clearing banks have got that kind of, you know, standard development investment financing of up to 55-60% LTC sort of covered. So what you're seeing is that, and you know, margins are being pushed there in terms of the downward pressure on them. But what you're seeing is some of those other lenders who need to get a slightly higher return, they are having to be creative. So you're seeing kind of stretch senior, seeing pref equity, you're seeing sort of, you know, whole cost loans, you're seeing back leverage. There's tons of different products out there, which obviously sort of, you know, help unlock a lot of these strategies. But one of the things that does remain, despite the fact it's competitive, is that it's all pegged against SONIA, or sort of, you know, as a rate. So we're taking a margin above that, and that does remain high. I think it's jumped again off the back of the Middle East crisis in terms of the forecast there. And in terms of rate cuts, you know, I think that's probably potentially going to be pushed out again, given what's going on and the inflation impact of that. So whilst it's a very competitive space, lots of people trying to get into, it is still, and for the right projects, it still does work. It's still accretive. It's still not having that bump that it, you know, once did, or it does in some other markets, where actually bring in some development finance actually significantly increases the return profile of the deal, just because of the fact that debt is still fundamentally still relatively expensive. Yeah, probably my 2 cents on it.
Yeah, thank you, Bill. Okay, we're about to run out of time. This has flown by. You should be able to see the poll on the screen. It's quite significantly different from the LinkedIn one I did, actually. Co-living is a clear winner here today with 42%, followed by single family rentals. Multifamily and PBSA are neck and neck at 12%, and later living is the lowest scorer with 9%, which is perhaps not so much of a surprise, as it's such a complex sector. Thanks for your involvement, everybody. That was a great discussion. We're just going to show a couple of quick slides before we wrap up. We're going to leave the session open for a minute or two, so you can take some notes from the chat if you want to. Our next webinar is a really interesting one. Looking forward to this. It's about real estate tokenization and fractional investment, and what the implications of that might be for the living sector. We're certainly starting to see this, particularly in the Middle East. Governments starting to back these kind of blockchain backed property buying and selling platforms. So looking forward to that one. That's on the 17th of April at 11 o'clock. And if you'd like to join that one, you can see the link to register in the chat. If you'd like to work with us at Urban Living News on our online or in real life offers, do get in touch with my colleague Sam, whose details you can see on the screen and also in the chat. Finally, just want to say thank you. Thanks ever so much to Kelly, Will, David, and Richard for their fantastic contributions. Thanks to you all for watching. Hope you enjoyed the session. Have a great weekend, everybody, and I'll hopefully see you all on another webinar soon. Take care. Have a great weekend. Bye-bye.
At IHM, we believe in the power of connection. We exist to inspire, to inform, and to unite decision makers who are shaping the future of hospitality and real estate. Our why is simple. We believe this industry thrives when people and ideas come together. And we're here to make that happen. So how do we do it? We publish 4 leading multimedia brands, each a trusted voice in its sector. We blend intelligent content, curated events, and a strong community into everything we do, making it easy, accessible, and genuinely useful. From online engagement to face-to-face connection, we are known for being insightful, collaborative, and refreshingly human. We host world-class events, panel discussions, podcasts, award ceremonies, and webinars designed to spark ideas, drive conversation, and create impact. With over 62,000 monthly web visitors, 55,000 email subscribers, and 69,000 social media connections. Our reach is deep and our community is active. We're partnered with the biggest names in hospitality. and we'd love to connect with you. So whether you're looking to grow your visibility, meet the right people, or understand where the market's heading, read, watch, listen, and me. Do it all with IHM.